Hey everybody, it's Benny the Finance Dog here. Welcome to my channel. Today I'm going to be talking about pricing options as well as reviewing another winning trade from today. Let's start with the basics. There are a few different factors that can affect the price of options, including the price of the underlying asset, the time to expiration, and the probability that the asset hits the strike price. These are very high level concepts, and we'll do another video describing the Greeks, but for your understanding, these three things are essentially what makes up the pricing of options. The price of the underlying asset, or the price of an option, is directly correlated to the price of the underlying asset. The closer the price moves in favor of your strike price, the more valuable the option contract becomes. The time to expiration is the amount of time that an option has before it expires. The closer an option is to expiration, the less valuable it will be. This is because there is less time for the price of the underlying asset to move in the desired direction. Both of these factors contribute to the probability that the asset hits the strike price. The more probable a contract is of being, quote, in the money, the more value it has. That's why contracts with a strike price far from the current price of the asset are cheaper than contracts with a strike price closer to the current price. Stocks are less likely to make giant jumps than they are to make smaller moves. When choosing options to trade, it's important to consider all of these factors. You want to choose options that are for assets that you are familiar with and that you believe will move in the desired direction. You also want to choose options that have a reasonable amount of time to expiration and that are assets with high volatility as well as high probability of being in the money. Let me explain in this context why I like trading Apple options. First, Apple has split 5 times and now trades below $200. This makes it a fairly inexpensive stock for a large cap stock, which keeps the premiums down for its options contracts. Second, Apple has weekly contracts as opposed to daily, which allows for plenty of time for your trade to develop without being eaten by time decay like zero date to expiration contracts will. Lastly, Apple is one of the market leaders and reliably, but not always, moves to the upside, which is great for new traders who play the long side only, as they have a higher probability of being correct when purchasing call options. Now, let's review the charts to go over today's trade. As always, this first chart is the daily candles for the last year. As we can see, Apple had begun breaking out last week, but suffered a pullback on Friday. I've noticed over time that Monday and Friday are very highly correlated in terms of market direction and had a downside bias heading into today. Moving to the 4-hour and 1-hour charts, we can see that pre-market, that hypothesis was validated as Apple gapped down over the weekend and was set to open several dollars under the close price of Friday. Once the market opened, there was a bit of a rally as sellers from over the weekend were taking profit and Apple tried to recapture some of the losses from the weekend. But around 6:40, that calmed down and the downside move was set to continue. At 6:43, I purchased a put option with a strike price of $172.50 with expiration this Friday, May 26th for $81. As you can see on this chart, the move for the option contract went against me for a bit but did not trigger my stop loss, which was set at $71. Prices reversed and I took profit at $90 at 7 a.m. Overall, I was happy how I managed the trade and let it play out in my favor to a tune of an 11% gain. I could have let this run a bit more and captured more of the gains, but I also could have held on too long and had this trade move against me. By reflecting on your own trades, you can learn from your mistakes and improve your trading skills. I hope this helps. Tomorrow we will come back to discuss the Greeks and build upon today's lessons about option pricing. Please like and subscribe for more content. Woof woof!